Welcome, everyone, to a very special episode of Yahoo Finance Uncut. We have two guests today, not one, but two. We have Jay Woods. He is a Chief Market Strategist at DriveWealth. He is down there at the New York Stock Exchange. You're going to hear some bells and whistles going off on the floor there. We also have with us Callie Cox. She is a US Investment Analyst at eToro USA, and she is down in Charlotte, North Carolina. Welcome to you both. And Jay, as a former floor governor at the New York Stock Exchange, I want to start with you. And just, Callie, I'm going to come to you in a second and just want to get your overall reaction to the market maelstrom that we've seen this year. We recently had a huge rally up in June. It's been flagging a little bit. Note to our viewers, this is tape, so bear with us. We're not going to talk about charts of the day or anything specific, but we are going to talk in some general terms. We're going to talk about market psychology, et cetera. And Jay, want to get back to you. What are you thinking about the markets right now?
Well, right now we're kind of in a holding pattern, which I don't mind given where we came from. I mean, we had a tremendous three-year run leading into this year. In fact, the S&P 500 peaked day one right out of the gates, and it's been a slippery slope ever since. We are in an official bear market, meaning down 20% in the S&P 500. A lot of the stocks under the hood, a lot of the most recent IPOs, a lot lower than that 20% threshold, 50, 60, 70, 80% in some cases. So it's been a rough first half of the year. Second half of the year, we hit lows in June. We haven't retested them. In fact, the rally off the lows was tremendous, almost a little too exciting for someone like me as a technician. You want to see these rallies, but you can never call a V-shaped bottom. Not calling a V-shaped bottom, but we did have a heck of a rally over the last 2 months to end the summer, and we'll get into some technical levels later, but we retraced 50% of the lows. We're only down 11-12% for the year in the S&P 500. So in the grand scheme of things, on a big picture time frame, you know, it's not fun. A lot of retail investors, this is new to them, so I think we'll talk about that perspective as well. But going forward, I think we have some work to do. Base out a little bit, mean trade sideways, chop a little bit before we go higher. But I'm a seasonal type of guy. September's a rough month, but the last quarter of the year, I expect good things.
Yeah, and Callie, just your reaction to the general markets right now. Jay was using some letters, U and V. Haven't heard those in a couple of years. That was the original pandemic recovery alphabet that we're using there, talking about. But yeah, we came about halfway back in the S&P 500. NASDAQ went 25%, flagging a little bit. Summer, kind of seasonally weak or at least illiquid time of year. What are your thoughts?
Yeah, so I think Jay summed it up really well. And, you know, if I had to do a 30-second soundbite on this year, it's, you know, the trend, the economic trend, the trend in inflation was getting worse from the beginning of the year until June. Of course, the Ukraine crisis, you know, made things, you know, ultimately more complicated. But the inflation trend was getting worse. You know, the economy was getting a bit worse. But now we're in a state where the trend is getting better, but we're still in a bad environment. And, you know, we've seen stocks and risk rally off the back of that. But investors are having a really hard time reconciling with this almost cognitive dissonance here. So, you know, we are in the summer, like you mentioned, Jerry. It's technically a time when everybody goes to the beach. They're not staring at their screens. Unless you're me or Jay, then you're staring at your screens all the time. But it's encouraging that the markets have handled this summer quite well, because I was honestly a bit worried that we'd see some pretty deep sell-offs just because of that lack of volume.
Yeah, and Jay, the Fed is a big part of this. We've been talking about, well, we always talk about the Fed because interest rates kind of make the market, but we're talking about inflation that we haven't seen in 40 years and the Jackson Hole meeting. Now, technically, this is forward-looking for us, but some of the viewers, it's going to be in the rear view mirror. My bottom line that I'm thinking is Jay is probably not going to be able to say much that's going the market up or down because he's committed to data dependence. That could change based on some verbiage, but just your thoughts on how the Fed has really changed its transparency. Oh, that's fine. Yeah. If you can hear me, how has the Fed transparency, maybe Jay's pivot to being extremely data dependent instead of just somewhat, really colored your view at all in terms of what the Fed may do?
Well, this Fed under Jay Powell has been extremely transparent to a point where there was a leak a couple Fed meetings ago when everyone down here was talking 50 basis point hike to no, it could be 75, and then, oh, miraculously it was 75. The Fed's in a tough spot. They know they've pretty much telegraphed every move they've made, and they're going to go data point by data point. We have, the PCE coming up. In retrospect, it came up for some of our viewers, but they look at each one individually and they break it down to see not how the market reacts. They're not supposed to be worried about how the market reacts, but how the economy is reacting. Have we hit that peak inflation? It looks like we may have. It looks like we've ticked down. The big debate down here, and it's something we may get into later, is are we in a recession? To me, that's just semantics. It depends what definition you look at. I know, when I was raised, it was 2 consecutive negative quarters of GDP, but they don't, it's the National Bureau of Economic Research that makes that call, and jobs play a big factor in that, and the jobs market is stronger than ever. So it's interesting to see how the Fed is navigating one data point to the other. They could focus on housing, they could cringe. One thing they don't control: fuel prices. And fuel prices, to me, are still a big story. We're seeing a little bit of a spike in oil as we tape this. Hopefully it's just a bump and we go back to that downtrend we've had over the last 2 months. But I think that, to me, will be what really drives the economy and the personal consumer going forward.
And Callie, want to get your reaction to not only what Jay said, but just in terms of the Fed kind of gaming the big picture here. What are your thoughts?
Yeah, well, you want a Fed that's transparent. I'll start off with that. You want a Fed that's considering both the upside or, the good risks in a way, the things that are going well for the economy. And also, of course, considering the actual risks as well. And that's what this Fed is really good at. The problem is right now, it makes this Fed really hard to read. And everybody is laser focused on what Powell says and what other Fed officials say. So the Fed is also in a tough spot here. They're being as transparent as possible. They're fighting an obvious inflation crisis. The job market, they're trying to raise rates to maybe cool down the job market a little bit, but we're not really seeing that for many different theories, frankly. So the Fed's, trying to pump the brakes. It's not seeing that flow into the job market, but we are seeing the effect of rate hikes in the housing market, in consumer spending to a certain degree, in, big purchases that sometimes you take out debt for. So the Fed is trying to do as much as it can, but it's faced with a super complex problem at the moment. I mean, I look at what the market is doing right now. I look at people talking about a Fed pivot, and I don't think it's that simple. The Fed, again, looks at inflation and jobs, and inflation is far from solved here. But at the same time, the Fed's also looking around the globe. It's looking at the other risks. It's looking at the places that have absorbed rate hikes and actually weakened because of that. And it's, quite the balancing act right now. So I would not want to be Jay Powell right now. That is a tough job to be in.
Does anybody ever want to be Jay Powell? I don't know, maybe 2017 when we had a VIX around 15 or 18 for most of the year. Yep. Jay, we've been doing kind of a top-down analysis here. I want to talk about investors, how it's affecting people's portfolios. We just had this big run-up, nearly 20% in the S&P 500, is about 25% in the NASDAQ. Anytime you get one of these, let's call it a bear market rally until it's proved otherwise. Anytime you get one of these, you tend to get a lot of junk off the bottom stocks. These are some of the stocks that got hit the hardest, rally a lot. So we saw a lot of short covering, but we saw some leaders emerge as well. Just wondering what you're thinking about where signs of strength and perhaps opportunity are crossing over as we solve this inflation conundrum.
Yeah, well, we did see a lot of big bounces off the lows, and we're talking stocks, high growth tech stocks that were down 70–80%. Some people may call that a dead cat bounce. Others, like myself, would see it's more of a mean reversion. These stocks were oversold. They fell out of favor, and they're, people have this fear like, oh, we got to get in. It's finally coming back. It's cheap enough where I can get in. But you talk about leadership, and in a bull market, you want to see high growth lead. You want to see technology lead. And we're not seeing that right now. Utilities just made a new high last week. Utilities are the one sector you do not want to see leading in, the next leg of a bull market. These are typical of bear market cycles. Healthcare, very strong areas within that sector. The XLV is kind of treading water. It's above its 200-day moving average. But, you see Merck, you see Bristol Myers, you see Pfizer, all at or near 52-week highs. Those are safer havens in times where you're a little uncertain. So while we're seeing pockets of strength, and energy has been the leader for the last 18 months, and it's still in its longer-term uptrend. This isn't what we want to see. We saw communications rally, we saw discretionary rally, we saw tech rally, but these sectors are still down 15 to 25% for the year. They still have a lot of work to do, in my opinion, to say, all right, here's the all clear sign, and we're ready to take that next leg higher.
Yeah, Callie, I think one of the big takeaways for me is that the entire summer I've been talking to professional traders, people who worked in the business for a long time. They've been waiting for a capitulation moment, either in price, which is a complete washout, or in time, which is they wear everybody out. As friend of the show, Brian Shannon likes to say, if they don't scare you out, they wear you out. I'm not sure we've seen it yet. Just wondering how you're preparing your clients, or how you have prepared them for the summer, and then the eventual return to liquidity in the fall here.
Yeah, so that's a tough question in a way. And Jay, what Jay was talking about, by the way, can you guys hear me?
We hear you fine.
Yep. Okay,
and we're talking about
sorry.
Jay Woods here, not Jay Powell, right?
Of course, yeah.
Okay.
That can be confusing, but yeah, sorry, my sound cut, so I'm glad you can hear me. Yeah, so I think that's a tough question in a way. And I totally hear what Jay is saying when it comes to market leadership. That's something we always watch here. But we've been telling our clients, and we are a retail brokerage, we deal with a lot of younger retail investors here. We've been telling them that, sometimes things don't really make sense, and markets tend to rally in your face when things feel the most uncomfortable. And we can't tell the future, of course, but we're trying to walk this line where we're saying, we're not really out of the woods yet, but at the same time, if this is the beginning of the bull market, and nobody ultimately knows if this is the case, if this is the beginning of the bull market, you cannot miss the early days. So it's costly to miss the early days of a bull market. We have tons of data from history showing us that. So we have talked to our clients in a very balanced way. We're telling them how to manage their risks, but at the same time, maybe get some exposure to the upside as well, because again, you don't want to be the investors sitting on the sidelines until the S&P hits those new highs, and then suddenly it's 50% more expensive to get back in. And our investors focus on growth investments as well. They're younger, they have that risk appetite, and they have that time to invest. So that's especially important to think about in the tech perspective as well. And tech is such an interesting sector these days. It got hit like it was in a recession, and there's surely going to be more collateral damage. But at the same time, we have these clients with 15 to 20-year time horizons that can take on that risk. So I think it's a bit of a different preparation, but overall, we've just been telling our clients to really focus on what you can do in this bull market. Try not to get too tied to forecasts. Really understand your goals and how much risk you can take.
Callie, I'm so glad you brought up risk and spent some time talking about that, because that's one of the things that I like to do with this. Since we're not talking about what did Tesla do this morning, Jay, I want to kick this to you, because you have been an active trader on the floor, off the floor for decades here. Your uncle is one of the godfathers, or the godfather, of technical analysis. How are you approaching risk management in an environment like this, or in any environment? Because it's always important to have risk management.
Well, risk management, as I say all the time, is job number one, job number two, and job number three of any trader. Anytime. It doesn't matter if you're a professional here at the New York Stock Exchange, or you're looking at your own portfolio, or you're advising clients. You have to have a game plan and a strategy. You have to know why I bought a stock, first and foremost. That was one of the things. We have so many new retail investors into this market that we got over COVID. And people always ask me, is that a bad thing? No, it's a great thing. We want them in the market. We want them to learn by doing. We want them here to stay. It's people like Callie, myself, that now have to teach them that job, that risk management. Stocks don't only go up, they can go down. And what we try to focus on with the retail investor is educating them and letting them know you have to have a game plan. You just can't buy a stock because it's going to go to the moon. You have to know your downside risk. You have to manage that risk well. And I think Callie hits on some great points. Know your time frame. If you are in this investing for the long term, and with DriveWealth, we have a retail trends report, and 46% of our active investors the first half of this year are millennials, and the millennials that are investing for the first time. And this is great. If their time horizon is 10, 20, 50 years, there's no better time when the market's on sale to come in and nibble on stocks that you know you use every day and you love. So, through my experience, I can tell stories about day trading and holding stocks for seconds on end and feeling like a lifetime. But in my role here at DriveWealth, the most important thing are those retail customers, those retail traders, and teaching them to understand the long-term horizon, knowing that risk, and managing that risk. Because if you don't have a game plan and an exit strategy, if something goes wrong, you may want to leg into a trade, buy something, it goes lower, and have cash on the sidelines to buy more, compound over time. These are the strategies that I employ. If we want to talk fun trading events down here on the floor, I'll indulge anytime. But I think the focus for this conversation, or at least this part of the conversation, as Callie mentioned, are those retail investors that are coming into this market that have that longer time horizon. And as much as I love to make quick trades, my role is to focus on the long term and those younger investors coming into the market to make sure they know, yes, this can be fun, this can be exciting, but if you don't have a game plan, you can blow up quickly, and that's the last thing I want to see anyone do.
Yeah, I'd echo that as well. And Callie, you're shaking your head here. By the way, Callie, you are the official voice of the millennial and maybe even Gen Z generations here, because Jay and I are obviously Generation X. We're not boomers. Just want to throw that out there, but we are Gen X. Seriously though, Callie, what are you telling your clients in terms of risk management, and then in terms of we've seen the gamification of stocks. So we all know the story of other brokers, and I'm not trying to single anybody out here. There is an evolution of technology. Maybe the pendulum went too far one way, but I think it's very important, as we've been nodding our heads here, for investors to know their risk, their time frame before getting into a stock or into an investment idea. What are you telling your clients?
Yeah, so first of all, I think it's fair to say that I'm younger than Jay and Jared. Jared, you're completely right about that. We don't even have to share ages. But yeah, I echo everything that Jay said. He just basically spoke my mind there. I mean, I'll add too, I think that retail investors get a really bad rap. We do plenty of surveys on retail investors across brokerage platforms, and many retail investors are those long-term investors who are investing to build that nest egg, or build, or to invest for retirement, if you will. They're the type of investors that may check their account often, but they don't, necessarily buy or sell things as quickly as, they're portrayed in the media. So we have to also understand, the crowd that we're talking to here. There will be speculators in any age group, and younger investors, again, have a higher risk appetite, so they're willing to take on more risk. But at the same time, we have those long-term investors, and we have those customers who step in and say, look, I just want to make money over time so my kid can go to college, or so I can buy a house 10 years down the road. So that being said, I mean, we are talking to different camps here. In terms of risk management, we've really told our customers to lean on the numbers here. Know your entry points, know your exit points. I mean, along with the great advice Jay shared about knowing your goals and knowing your time horizon, use that to guide you, and then lean on the numbers and be really honest with yourself too. A lot of people say that they get into investing to, make money and be rich, and that's all good and well, but can you narrow that down a little bit? Why do you want to be rich? Why, what do you expect to do with your money in the next 5, 10, 15, or 20 years? Because believe it or not, that dictates where you put your money. So we're trying to approach it from a psychological angle as well, telling people that there are different ways to invest, that, your friend isn't exactly like you. So, it's great to have friends and follow what they do, but at the same time, know yourself and understand that you deserve a portfolio as personal as you are. And at the same time too, teach them how markets work and teach them that ups and downs are normal. But the best investments you can make over time, according to history, are the ones you make when the market is most painful. So I know that that's a big mouthful, and there are plenty of different angles I could talk about from there. But, we approach it in a psychological way, and then we try to get the investor to connect to what they need, and then we guide them from there.
Yeah, and let me just expand on that, because in the current market environment, you talk about the ups and downs of trading, Callie. We've seen vicissitudes of a magnitude that I haven't seen maybe ever, and I've been following the markets somewhat closely over the last 2 decades. Jay's been in this longer than I have. I'm just wondering how your approach is, especially being a bit more millennial focused on exactly how to navigate this, because a lot of people trade based on their first bear market. And for a lot of people, you can count the pandemic as part of that, but it was so quick, it was almost a non-event because we were right back up at highs within, I don't know, 6 months or so. How are you and your clients and basically your generation viewing the markets right now? And how are you trying to shore up a little bit more trust that in the long term, things are probably going to be just fine?
Yeah, well, to be fair, I'm going to say something, on the account of all millennials and Gen Zs out there. We may not have been investing for so long, but we have seen some stuff in our lifetimes. I mean, I'm an older millennial, and my parents were both laid off from their jobs during the great financial crisis. Certainly didn't have an investment portfolio out there, but I felt the financial effects of it. So I think that the criticism of millennials and Gen Z not seeing a lot of market volatility is a bit unfair there. Not saying that you said it, Jared, but yes. I get it a lot, and it's just a little off in a way. But thinking back to where we stand, how we're seeing these markets, I like to lean on the data. I love looking at how markets have reacted, relative to history, and just how long it takes markets to rebound, because the average investor, if you ask them how they think the stock market has acted over time, they probably say something like this. But if you look at the line chart, it's like this: the call option on society. So, we try to remind our investors of that. We try to, tell them about the classic investing advice: invest in what invest, based on what you want to do with your money. A lot of investors are really receptive to that, because from a millennial and Gen Z perspective, we just want to participate in society. We want to do, as well as our parents did and more, and we're trying to find ways to do it. Investing is one of those ways that you can grow your wealth, and we're just asking how to do it. Nobody's really answering our questions. But we also bring a psychological component to the table as well. We want to invest our money, but we care about our wellness, and we don't want to drive ourselves insane trying to make this money. So I also like to emphasize that no investment strategy is worth your sanity here. And if you're not a day trader, which many people aren't, then that's completely fine. You still have a way to invest.
Yeah, and sometimes you just got to tune out the noise, and you got to tune out the news, and that's coming from somebody who's in the news business. So don't take that with a grain of salt. It's heartily meant. Sometimes you just got to turn it off. Jay, Callie was just talking about historical analogs and the length of time that we're in bear markets, and easy for me to forget sometimes that the 2008 to 2009 bear market was pretty prolonged, not as long as a dot-com bubble burst, which took years, and we're not even including the time that it took to get up to new highs, but it would not be unusual because bear markets tend to last longer, I think on average, than we've been in so far this year. Any past analogs that could be prologue here, or just general advice on how to approach these things and not get too frustrated by the fact that the markets are still going down or sideways or just not really holding on to any gains?
Yeah, well, as a technician and a market historian, you always want to compare this cycle to something that looked similar or felt similar. And having lived through the great financial crisis, 07 to 09, right down here, where we saw a lot of people in the financial industry impacted. It was, living through it was one thing. It seemed like it lasted forever. When you're in a bear market, it feels like it lasts forever. You don't want to look at your portfolio. You feel that knot in your stomach. You feel sick. But at the same time, I know when I was much younger and living through that great financial crisis, I went home one day and I'm like, this is awful. And I took that contrarian approach and that smart approach, learning what I had learned watching people, blow up during the dot-com bubble, or seeing it during the recession, 91 through 94. We had a little bit of a recession and a tough time there. People don't remember that. One point sticks out at me. I had young kids at the time, and you're investing for their college, and I looked at my wife and I'm like, listen, if we don't come out of this, no one's going to college. There won't be college to go to. So when it seems like you're at the end of the rope, that's when you really want to dig down and invest and know what your long-term horizon was. And putting money into 529 plans and buying stocks that I knew when it felt like the worst thing in the world you could do at that time was the smartest thing I ever did. And that kind of pivots back to Callie's point with the millennial and the Gen Z investors with that long time horizon. This is a welcome opportunity, and people can do it like they've never had access. You talk about the speed of the market. You said that the COVID correction felt like it never happened. Well, we were down here, Jared. That was a horrible experience. When you remember when they walked us off the floor and they shut down this building, March 23rd, that was not fun. But yes, it was a buying opportunity, and through my experience, when you feel that pit in your stomach, you feel like it's the end of the world, you try to tune out the news, which is one of the harder things to do. That's when you hope you have that backup plan and that cash on the sidelines, and you're ready to act, because over the long term, you're not going to catch the bottom. No one catches the bottom. You hear the expression catching a falling knife. That's the worst thing to do. As a technician, I'd rather buy something in a strong uptrend, but as a human being, it's so tempting to see, oh my gosh, this stock is down 50%, it's down 60%. Remember, it was at 400, now it's at 40. We got to get in. No, it doesn't. Things take time to turn around, and with the indexes, they'll turn around over time, and they'll turn around in a way that you're diversified. So buying index funds and buying a basket of stocks is the way I always look at it and recommend to people, especially new people into the market. But getting back to the whole speed, people have access to the market like they've never had before. People can just pick up their phone and buy stock. They can buy fractions of a stock, and that's kind of why I pivoted to DriveWealth. Being pioneers in fractional trading, this is where I see that next generation going. And I'd rather be on the road to what's next instead of staying put in a spot where it's just is what is. And that's what excites me about the next generations. They have access, and it's a global market. I get to talk to people in Kenya, Nigeria, South Korea, Mexico, and we get to talk about U.S. equities. So I get to talk about what I do for a living, and to a whole group of investors who now have that global infrastructure, that rail, if you will, to gain access to U.S. markets. And that, to me, is the exciting pivot. So when we look back in time and we say, it's like this, it's like that, there are always similarities, things always rhyme, but each time it's different, and this time is different. And I don't know how it's going to end, but I would be willing to go out on a limb and say we'll get through this, and we'll end up making new highs within a couple of years, if not sooner.
Yeah, all good words there, and I'm listening very much so. I want to break things up and get to a clip we have of Neil Kashkari. He is the Minneapolis Fed president. We interviewed him recently, and he was explaining the cognitive dissonance that some people have between the economy and what's actually going on in the markets, and then specifically with respect to the Fed's dual mandate, which is stable prices, which the Fed interprets to be 2% inflation, and also maximum employment, and what the Fed is exactly doing here, trying to balance that tight line. Let's take a listen.
We always talk about our dual mandate, maximum employment, as many people working as possible, and stable prices. Think of an economy that's not overheating, but not also limping along. And those two things are like a seesaw. If the economy gets really hot, the unemployment rate will drop, but then you might see wage gains go up. So in that environment, we would tend to raise interest rates to make it a little bit more expensive for you to get a car loan, or for you to get a mortgage, or for the business to get a business loan, which will tap the brakes in the economy and bring these two things back into balance, just to steady things out. And if we're getting into a downturn, we will try to cut interest rates to make it cheaper for you to buy a house or cheaper for you to buy a car, which then makes it more likely you're going to buy a car. That provides some stimulus to the economy, and that provides some boost. So when I explain things that way, most people say, oh, I get that. I understand now how interest rates affect me.
Callie, I'll get your quick reaction to the Fed's dual mandate and how they're kind of thinking through this, and maybe how you talk to your clients and explain some of the cognitive dissonance that we were just referring to.
Yeah, so I think that goes back to what I was saying about the Fed earlier. I mean, the Fed, when you boil it down, they have a dual mandate. Like Neil said, they need to keep inflation under control and promote healthy employment or a healthy job market. And those two are kind of at odds right now. Inflation is a bit out of control. It needs to be tamed a little bit. At the same time, the job market's hot, but there is a connection there in wages, wage growth. Wages are about 80 to 85% of business costs on average. So we all love a higher paycheck, but usually that translates into higher prices, and that's inflation. And there are a lot of different connections there that people speculate about and they talk about. I mean, obviously, if you are an investor and you watch your portfolio go up, you're probably more likely to spend your money. You're probably more likely to invest, and that indirectly leads to inflation as well. So there are the two pieces right here, and this is how we frame it for our customers. There are the two pieces. There are the dual mandate, but there are all these little connections that you need to think of in between. And to a certain extent, if you're a long-term investor, what the Fed does isn't as big of a deal. It's more noise in the short term versus, kind of signal in the long term. But right now, as you're watching the Fed, and if you are somebody who's getting close to your goals or is a shorter term investor, as you're watching the Fed, you have to remember that they're trying to balance out these two areas. And, it's kind of tough. You mentioned the Fed's 2% target. I mean, that's a target they put out there for years, and one could argue that it's not as realistic these days. It's one that needs to, potentially be updated. But at the same time, I mean, inflation at 8.5% year over year, I mean, it's a far away from 2%, and I'd hazard a guess a far away from what the Fed considers as normal. So, you go back to what the Fed's seeing, how it's satisfying its dual mandate, but also how it's trying to guide investors to what it'll do next and how it's leaving the door open to what it needs to do if the job market does weaken suddenly or growth weakens suddenly. So it's a bit of a balancing act here. Again, for longer term investors, we tell them, don't focus too much on the headlines here. Obviously we don't want the economy to, get any weaker than it is right now, but, over time, the economy is able to recover and down markets tend to recover. But if you are, focusing on what the Fed is trying to do right now, and inflation is slowing, that may affect some of the opportunities you see here.
And great explanation there. Jay, I want to kick it to you on the markets and the technical side. As a market technician, what are you specifically looking at in terms of markets? Could be the US dollar, which has been very strong recently, maybe short-term rates, maybe long-term rates, maybe the S&P 500. What are you looking at for signals in the market and some of the charts that maybe we are entering a more risk-on environment finally?
Well, I think the dollar has been really driving the bus. If you look at a chart of the dollar, as that rises, we tend to go down. So you don't want to see the dollar strengthen as much as it has been. And the way that it strengthens, the way the moves in the bond market, the 10-year moves like it's never moved in my career. Every day you're seeing wild swings where day traders can actually, jump in and succeed to trade the bonds. It's kind of crazy. So what we would like to see is a little stability. That 3% yield in the 10-year is something we focus or hyper focus on here. We'd like to see it stabilize there, if not start to trend lower again. The dollar, every time it spikes up, we get a sell-off down here on the floor. And then oil. Oil is the X factor now. We're coming into a winter season where it may not affect us here in the United States, but from a global point of view, Europe may have some problems. What's going on in Ukraine and Russia is going to have a deep impact on the European winter. And if they get a cold winter and there are some pipeline issues there, that will cause prices to rise, and you could see the dollar strengthen some more, and that could lead to problems here. So those are the things I'm worried about. Technically, we talked about the shape of a bottom, the V-shaped recovery where it's fast down, fast up, or more of a U-shaped. And I think from my experience and from the conversations I've had here on the floor, it would be better and healthier for this market to have a U-shaped recovery. You want to see things start to churn and start to not go down on bad news. And I think we saw that this earnings cycle. We had some stocks with some negative news where they didn't sell off and make new lows. And those June lows have been critical, not just in the individual indexes, but in some big names, Walmart's and Meta of the world, stocks like Sherwin-Williams in the material sector. These are leaders in their groups, and their news wasn't too great. Their earnings were okay, but they didn't sell off. So what we're seeing are some bases formed, not just in the overall sectors, but individual names that can lead us out of this. So to me, technically, we want to see some sideways action. I mean, I would love to make new highs and see us jump, but with the Fed in a rate hiking cycle like it is now, the old adage, the Marty's White, don't fight the Fed, that is rule number one down here. And as long as the Fed is in that rate hiking cycle and all indications lead that it's not going to slow down anytime soon or pause, God forbid they cut, which was a rumor last week. I don't know how that started. I think we'll be chopping sideways for a little bit.
All right, Jay, we're going to stick with you for a second. Let's have some fun, get into some war stories. You've been at the exchange, or you were at the exchange, you are right now, for decades. I know your career kind of started out at Goldman Sachs, but just tell us some of the more interesting things, maybe people you've met down there at the exchange over the years.
Wow, I mean, we could spend hours and go on so many tangents here. I started, and this is the story I like to tell because it is relatable to the next generation. I started as an intern. I was someone that wanted to go to law school. I had no interest in finance, believe it or not. Even though I had been charting stocks at 8 years old, I got my first stock, 2 shares of IBM for my first communion at 8. So I was learning by doing, and I was charting the stock because my uncle was a technician, and he demanded that, you know, if I'm going to give you these 2 shares, you better tell me what they're doing. And then after a few months, I'm like, hey, Uncle Ralph, what is going on? He put a line from the lows, and he goes, which way is this going? And it's up. It's an uptrend. And so I got my early start by owning and by charting stocks. And then, you know, I pivoted with an internship here in New York City. I went to Fordham University, and that parlayed into an experience on a trading desk and an interview and an opportunity to work on the floor. To me, this is the greatest place on earth. It's the Yankee Stadium of finance. It's, you know, and if you're a Red Sox fan, I would stress it's the Yankee Stadium of finance. It's just the greatest place. I've been blessed to be here for 30 years. The people that come through this building, too many names. You get leaders of countries. I've met with 3 first ladies. I've met with dozens of senators and congressional leaders. Being the specialist for the stock that owns the New York Stock Exchange, the Intercontinental Exchange, ICE, was one of the highlights of my career, getting to work with Mr. Sprecher and his team and getting to be the face of the floor when people would come here and I get to talk to them. So too many highlights. If I was to pick one, it would be 9/17/2001 when we reopened. There was no more patriotic feeling than being down here on the trading floor, being the first people to go back to work after the Trade Center got hit, which was just blocks from here. We did lose 2 members that day, but getting to see everybody come back. As a market maker, I was going to lose money that day. The market was down 7%. You knew you'd have to be on the other side of those trades. It didn't matter. It was the most patriotic thing I've ever been a part of. I still get goosebumps thinking about it. To see who was on that podium from a political point of view, these people would never stand in the same room together. You know, it's nothing you wanted to live through, but to be part of that opening bell, to say America's back, and just to be part of the team down here, there's no better feeling in my career. But you know, we could go on with war stories, but if I was to pinpoint one day in my career, that would be 9/17/2001.
Pretty amazing. That was only 6 days after 9/11. And Jay, you can't see our program as we're running here, but we're just showing clips of that I got from your Twitter feed. We have you with a number of people, characters, giving students a nice tour of the floor there. So I hope you watch this video. Might be some nice surprises in there for you. And Callie, be remiss here if we didn't ask you how you got your start and maybe a little bit of background. And by the way, I did troll your Twitter feed just a little bit, but it turns out most of your Twitter feed in terms of personal pictures only features one prominent member. I'm going to leave that to your imagination, but oh, there you go. All right, we're going to give it away. Is that
Ozzy would be so thrilled to know that he's appearing on a Yahoo Finance show. All right, roll him. I'm kidding. So yes, Jared's right. I love my dog Ozzy. But to how I got my start, I got my journalism degree out of school, and I was lucky enough to get an internship at Bloomberg. Started off full time with them as an options reporter, but really made a name for myself writing about the options market in a daily options market column for Bloomberg clients. And that's about the nerdiest thing you can do in journalism, but I also built up a following outside of that, just looking at historical analogs, talking about things that I found interesting in markets on Twitter, and, you know, almost posting some of my original research, you know, spit little parts here and there. I'm not talking like long notes. But, you know, I started off with an interest in the market. As I learned more, I loved just taking in, you know, what money means to people and, you know, how different people view money. And that's why I talk about, you know, finding your why a lot, because you think of your money differently than your friend. I think of my money differently than my siblings, than my neighbors, you know, all of that. And that was the one apparent theme to me as I went throughout my career from journalism into research. And I really have a passion for helping the retail investor. I really never learned about investing growing up. You know, my parents never really talked to me about it other than, you know, invest for retirement, what all of our parents say. So I, you know, have a special passion there, and, you know, connecting what you see in your money to, you know, what your lived experiences are with your finances. So I feel really blessed to be in the position I'm in right now. I love serving retail investors. I love, you know, getting on their level and telling them that nobody has it all figured out. I'm figuring it out right now. You know, Jay's probably figuring it out right now, although he's a little bit further down the path. You know, we're all in here together, and that's what makes, you know, markets and investing so much fun. Nobody has mastered it, really. It's a challenge for everybody, and it changes every day. So I love, you know, driving my career along those themes and, you know, just stepping out there and joining the conversation.
Callie, I got to make an admission. I think as the older I get, the more I'm convinced that everybody's just kind of making it up as we go along here. We showed a quick picture of Ozzy before. Want to follow up because we do have a number of these pictures in our arsenal. Just tell us a little bit about Ozzy and how he helps you and the retail investor in your approach to trading and portfolio management.
Oh man, well, Ozzy's a bull. He's a very optimistic little pug. He reminds me every day to look on the bright side. Sometimes he's my junior analyst, but he falls asleep on the job. That's a little unfortunate. We're working on him. He's on a performance improvement plan, but he's also trying to bargain for more treats. So I get it. It's a give and take.
Well, we hope that he gets those bonus treats, retention, something there. I'm just stringing words together. Okay, we've had a lot of fun here. We want to keep having a little bit of fun, but also bring it back to a serious tack. We talked a little bit before, Jay, about risk management and some approaches that people can take toward their portfolio. Let's say you're not an active trader. Let's say you're just maybe a passive investor. How would you be viewing the market right now, and how would you be thinking about, okay, I got some losing positions, I got some winning positions, what am I going to do here?
Yeah, that's a great question. Losing positions are always the toughest, because once you own a stock, you look at it differently. You become married to it. You're like, oh, you know, and you know your break even, and if you believe in one of the stocks that you're down on your luck with right now, you think over the long term it's a good story, then maybe you want to cost average down a little bit. I'm of the ilk that you know going into it, if it goes down 10%, you know, from a technical point of view, I'm out. I want to revisit the trade. I take lots of notes. I advise anyone that wants to be an active trader or just an intermediate trader to make sure you're writing down your process. Write down, why did I buy this stock? What was my thinking? As a superstitious trader down here, what did I eat for lunch that day so I can eat it the next day because I had a good day trading? You know, the retail investors, I learned more from them than I could ever. You know, I won't tell this to my kids. I'm not going to say, hey, you guys are teaching me lessons when, you know, you're making crazy moves in the market or you know, getting involved in the coin of the day. But I like the fact that the younger investors are more cognizant of what's going on, have that access, have the ability to just learn by doing. But the risk management, like you said, is number one. And what I would tell them, one, diversify. Don't put all your eggs in one basket, because this is the next stock that's going to the moon. You know, there's a lot of FOMO in this market, the fear of missing out, the next big thing. Guess what? I've done it myself. We're all guilty of it. I bought Google on its IPO day. I made 50% and I sold it. Yeah, I still think about that one every day, but that was my goal. I didn't know it would actually go to the moon. So you just have that strategy. If you reach your goal, cash out a little bit. It's okay. No one ever went poor by taking profits. You are going to miss the big one from here, here and then, but just make sure you have that game plan. That's the most important thing to me, because I don't like the new investors that just come in because it's a revolution or it's a cult or it's a cause. If it works, great, but as long as you have that risk management and don't blow yourself up, then you'll be fine. Investing is not easy, but if you're in it for the long term, you're in it for the right reasons, you're diversified, you're going to do okay.
Yeah, and over the long term, stocks tend to go up, with some periods in between there. Of course, we have bear markets. Callie, just your thoughts on what Jay's talking about. We talked about risk management before, but in terms of you, the millennial of the group here, and your approach to the markets, having come up in a time of very low interest rates, things are changing right now. How do you talk to some of your clients about what to expect in this kind of environment?
Yeah, definitely. Well, first of all, I want to echo, everything that Jay said there about, writing down your process, determining your game plan. That is sage advice, no matter what age or stage of your life you're in. But thinking about the millennial and Gen Z investors and the world that we grew up in, I mean, we've had our own financial struggles ourselves. Again, we lived through the great financial crisis. We lived through the dot-com bubble. I mean, we were on the other end of the boom post-GFC. Many of us were. So, we're already one step behind everybody else. And that's not to complain. It's just, speaking about where we are. We're buying into many markets that are already expensive. So we're, naturally accustomed to looking for a little bit more growth. We're in a better spot to invest in growthier stuff because we have that risk appetite. But that makes it even more important to have that plan. And that's, what we emphasize again and again to our customers. And, personally, it's something that I want to show through my research. I can look at, the trend lines all I want. I can look at markets, sectors, trades all I want. But ultimately, when you talk about on a customer-to-customer basis, they know the best thing for their portfolio. And I want to keep them informed, but at the same time, I want to guide them to the point where they can understand exactly why they're investing and what they need to do in times of trouble. I want them to be the best informed they can be, but at the same time, I want them to be, armed with enough knowledge on their own end to understand exactly what moves they need to make in crazy markets. But one other thing I'll throw out about young investors, I mean, we're sitting here, watching inflation. We're in a high inflation, low yield environment. That's pushing us more and more toward growth. I feel it in my own investing strategies, and I know my friends and younger family feel it. So I think that that's going to be a burgeoning trend. It already is a trend, has been a trend over the past decade or so, the low yield environment, but that's becoming even more and more desperate these days. So I'm interested to see how that plays out over the next decade or so.
All right, Jay, we're getting toward the end of our time here. I'll just give you the floor. Anything you want to say about investing, charting, technical analysis, fundamental analysis, anything that we haven't talked on or touched on just yet?
No, I really like this conversation. I like hearing Callie's perspective on things because the younger investor has access like they've never had before. Quite frankly, I'm jealous. We had to jump through hoops to buy stock down here. We have to hold them for, in the industry, you have your own different rules. But I'm excited for the retail investor, the access they have to the market, the access they have to people like Callie online, where you can just follow them on social media and get valuable information. What you do on Yahoo, content like this. We never had anything like this. We didn't talk about money, as Callie said. It was kind of taboo. And now the kids, they can just buy notional value of stock, $5 on my phone. There we go. We're invested. And they learn compounding. They're going to learn rewards programs. That's the next big thing. You can go into your coffee shop and buy $4.12 worth of coffee. And all of a sudden, hey, would you like to round that up to shares of our stock? Well, sure. And now you have 88 cents of that brand that you use. So there will be brand loyalty. The companies that do have rewards programs, they're going to have that user base that's going to consistently come back to them, a little buyback, if you will, because they're rounding up and they're getting involved. They're buying what they know and they use and they love every single day. So I think there's just so much coming for the younger investor that quite frankly, I'm jealous. I mean, we had to pay, our big thing was when we got $9.99 trades, and now they trade for free, and they have it in the palm of their hand. What could be better than that? When you then have access to people who've been around and just say, okay, all right, this is great, but there are risks involved, and you want to just kind of diversify, you want to have a game plan, and that's why I think programs like this just put it all together. So thank you for having me, and I won't go on that tangent I wanted to about the Philadelphia Eagles and the football season coming up. We'll keep it strictly to the market, and this has been good. So thanks for having me, Jerry.
Yeah, and we're not done just yet. I'm going to get your reaction, Callie. Not reaction. I'm going to give you the floor, same as Jay. Anything you want to say, except about any sports franchises to the investing public here.
Well, I'm glad we're not talking sports franchises, because I'm a Carolina Panthers fan and we can't talk about a lot these days. But, I've really enjoyed this conversation. I had a blast in it. This is my favorite conversation to have when it comes to the markets, just about how retail investors are changing the game, changing the landscape of investing. I liked what Jay said about rewards programs. I think this theme of brand loyalty and younger investors wanting that sense of community and belonging in their investments is just such an important one, and it's one that we're seeing come through more stock splits, through investor rewards programs, through free popcorn that you can get at a certain movie theater chain if you're an investor. But I think that the future is just so exciting with all the movement that we're seeing today and just the empowerment we're giving to the younger generations. And I want to say something to the younger investors too. If you're watching this program and haven't invested yet, pat yourself on the back here. You're doing better than a majority of people because you are thinking about how to put your money to work. Try investing. The best way to invest is to try it and learn. It's okay if you make mistakes, and stay engaged with it. You never know where it'll take you.
Yep, no substitute for real trading with real money. Wouldn't try the paper trading. And you can open up an account in seconds, if not minutes, with a nominal amount of money. It took me, Jay, a couple weeks back in the day to open up my very first futures account. I still remember that. It seemed to take forever, but the future is here. The future is here. And we're going to leave it right there. Jay Woods, Callie Cox, thank you so much for joining us. And this has been another episode of Yahoo Finance Uncut.